Quick heads up before we start. This is for education, not personal advice. More on that later. Every fall, there's a form. It shows up in your inbox with a subject line like, Open enrollment ends Friday, and it asks you to guess, correctly, a full year in advance, exactly how much you're going to spend on childcare. Not roughly. Exactly. Guess wrong, and you either lose money or you leave money on the table you didn't even know was there. Welcome back to Raising Capital, where we take the stuff that makes parents want to lie down on the kitchen floor and turn it into something you can actually use. Here's a number that should make you sit down. From birth to kindergarten, the average family spends around $58,000 on childcare. Not private school, not college, just care. So you'd think, with a number that big, the government would make it dead simple to save on it. It does not. It gives you two tools, and here's the twist. You can't fully use both at once, and almost nobody explains that part out loud. So let's fix that. Tool number 1 is called a Dependent Care FSA. Think of it like a bucket that sits right next to your paycheck. Before your paycheck gets taxed, some of it drops straight into that bucket instead. As of this year, you're allowed to put up to $7,500 in there. That's a big jump from the old limit of $5,000. That money skips income tax and it skips payroll tax too, which is honestly the best kind of skipping. There's a catch, and it's a specific one. If you earned more than $160,000 last year, your employer might cap what you're allowed to put in, sometimes way lower than $7,500. It's called the highly compensated employee rule, and the cruel irony is the parents who could benefit most from the full bucket are often the ones who get told they can't fill it all the way. And this bucket has a strict rule attached to it. Use it or lose it. Whatever you don't spend by the deadline just evaporates. No rollover. Which is why every December, parents everywhere are frantically prepaying January's daycare bill or buying summer camp gift cards just to avoid handing money back to nobody. Tool number 2 is the Child and Dependent Care Tax Credit. This one works completely differently. Instead of skipping the bucket entirely, you pay for care with regular after-tax money, and then at tax time, the government hands some of it back as a credit, anywhere from 20% up to 50% of your expenses, depending on your income. But there's a ceiling. $3,000 in expenses count if you've got one kid, $6,000 if you've got 2 or more. Here's the part almost nobody explains, and it's the whole reason this episode exists. These two tools are not friends. You cannot use the same childcare dollar for both. If you fill that FSA bucket all the way to $7,500 and you've got 2 or more kids, you have officially used up your entire $6,000 credit ceiling and then some. The credit doesn't just shrink. For most families with 2 kids, it disappears completely. 0. Which means maxing out the bucket you were told to max out can quietly cost you the other benefit entirely, and nobody sends an email about that part. Let's make this real, because abstract percentages don't stick. Actual families do. Say you've got 2 kids in daycare, and together you're spending $18,000 a year. You and your partner bring in $90,000 combined, which puts you around a 22% tax bracket. If you max out that FSA bucket at $7,500, you save roughly $2,200 once you add in the payroll tax savings. But remember, that $6,000 credit ceiling is gone, eaten alive by the bucket. So your total savings for the year is whatever that FSA gave you and nothing else. Now take a different family. Same 2 kids, same $18,000 daycare bill, but this time you're bringing in $45,000 combined, which puts you in a much lower tax bracket, but a much higher credit rate, something like 35%. If this family skips the FSA bucket entirely and just takes the credit on the full $6,000 ceiling, they walk away with roughly $2,100, more than they would have gotten from the bucket. In this family's case, the credit wins, even though it feels like the smaller, less official sounding option. Same 2 kids, same daycare bill, completely different right answer. That's not a coincidence. That's the entire point of this episode. Now, why does this actually trip people up so badly? It's not that parents are bad at math. It's that this system is basically designed to be guessed at once a year under a deadline, while you're also arguing with a 2-year-old about socks. You're asked to predict your childcare spending for the entire next year before it happens. Rates go up. A nanny quits. Your kid ages into kindergarten and stops qualifying entirely. You get a promotion and suddenly you're capped by the very same rule that was supposed to help you. And it's not just the math that's the problem, it's the timing. You have to make this decision during open enrollment, which is usually a single week, buried in a stack of other decisions about health insurance and life insurance and a dental plan you'll never fully understand either. Nobody sits you down and says, hey, before you pick a number, do this 5-minute comparison first. You're just handed a blank field and a deadline. So parents freeze. They either wildly overfund the bucket out of fear of losing the benefit, or they never touch it because the whole thing feels like a trap with paperwork. Some people just default to whatever number they picked last year because redoing the math feels like homework nobody assigned. That hesitation has a name. Some people call it decision paralysis. I call it the parental guilt tax, the invisible fee you pay every single time you almost figure this out and then don't. Here's the good news. You don't need a financial degree to make the right call. You need one comparison. Take your tax bracket, add 7.65% for payroll tax, and that's roughly what the FSA bucket saves you. Then look up your credit rate based on your income. The lower you earn, the higher that percentage climbs, all the way up to 50% for lower income households. Whichever number is bigger, that's the tool that wins for your household. Higher earners usually come out ahead, maxing the bucket, the same way our first family did. Lower earners often come out ahead, skipping the bucket and taking the credit instead, the same way our second family did. And if you're spending under the credit ceiling anyway, $3,000 for one kid, $6,000 for 2, the credit often wins no matter what, because you were never going to fill the bucket that high to begin with. One more thing worth knowing, because it changes the math mid-year for some families, this isn't a decision you're locked into forever. If something changes, a new job, a layoff, a kid aging out of daycare, that's usually what's called a qualifying life event, and it can let you adjust your election outside of the normal open enrollment window. Most parents don't know that option exists, so they just ride out a bad guess for 12 months instead of fixing it. That's it. That's the whole decision. 5 minutes of math instead of a year of guessing. Quick disclaimer, because I'm not a licensed financial advisor, I'm just a tired parent with a calculator and questionable drawing skills. Every household's tax situation is different, and this isn't personal advice. Talk to a real tax professional before you make your open enrollment elections. If this helped, stick around, because we're going to keep breaking down the stuff that actually affects your bank account. Explain the way I wish someone had explained it to me on 4 hours of sleep with cold coffee and zero judgment. See you next time. Go double check your open enrollment deadline.